Let's clear something up immediately and disavow ourselves of any type of fallacious belief. Markets do not care about reality. They do not care about truth. They do not care about fairness and equity. They do not care whether the economy is healthy, sick, or convalescent or dying. Markets care about response. Specifically, who will react, how fast, and with how much force. This is the mistake most people never recover from. They believe markets are observers of reality. They're not. They are the anticipators of intervention and liquidity. Now, you were taught, like me, a simple model. Good economy equals market up. Bad economy equals market down. Now, that model worked, also fleetingly briefly, in a low leverage equilibrium system, in a low leverage, low chaos kind of world. But that world is gone. Today, reality is entirely secondary. And policy reaction
Central bank's
is
monetary
primary.
policy dictates the flow of
And
liquidity
once you
into the
understand that,
parched economy.
the market stops feeling insane. It stops feeling inexplicable and untethered from reality. When an economic report hits the tape, the market does not read it like a human does. It does not think growth is slowing, consumers are stressed, this is bad. No, it thinks, what does this force the policy maker to do? That is the reaction function. Markets are not pricing the problem, they are pricing forwardly the solution before it exists, before it's announced, before it's admitted. That intervention might be rate cuts, it might be liquidity facilities, a new acronym, balance sheet expansion, regulatory forbearance, or fiscal coordination. The form changes, the reflex does not. That reflex and reaction mechanism stays the same. It's quite reassuring in ways, I guess. Markets are not trading GDP. They are trading thresholds. This is why bad news can be bullish. Bad news feels bearish, but bad news increases the probability of response. And the probability is what markets trade, the distributions of policies. If the economy is too strong, policy tightens. Liquidity withdraws, volatility rises. If the economy weakens, pressure builds, intervention becomes more likely, liquidity returns. So deterioration can actually be supportive. Not because the market is stupid, no, but because it is forward-looking. It's a forward-looking future discounting mechanism of a beast. Markets are not a judge. They are not moral. They don't care in equanimity or fairness. They don't care about moralistic turpitude. They do not reward good behaviour or punish excess. They respond to brute, sheer, unadulterated empirical power. And in modern systems, power is exercised through policy. This is not some type of modern manifestation of an accident. Every crisis follows the same trajectory, the same telemetry, the exact same arc. Reality deteriorates, markets wobble, policymakers hesitate, stress escalates, intervention arrives on the doorstep, and markets reprice before it happens. By the time the responses are official, the trade is crowded. This is why you are always late, ostensibly. If you wait for confirmation, you are late. Because the market moved when the probability shifted. And that happened as soon as the issue and the event arose. They front run reaction, not action. Now, most traders, they operate on the first order basis. They trade the earnings, inflation prints, jobs data, headlines. Institutions trade second order derivative effects. They trade how policymakers interpret the data, or how they are going to interpret the data, what constraints they may face, and what they are forced to do next. That gap, that void, that unfathomable, unbridgeable, ungirded void is where retail seems to always lose money. Valuations became secondary when risk stopped being real. When downside is socialized, valuations are able to stretch. If losses are absorbed by the central banks and the institutions et al., governments or the currency, pricing becomes asymmetric in that scenario. And upside is very, very much privatized. Downside is nationalized, distributed among the public, and it shows up and it rears its head up in an educational budget pitfall, or infrastructure, or potholes in your road, or your hospital not having enough doctors. Now, that has the effect of changing behaviour. It changes positioning, it changes markets. The more levered the system then becomes, the more sensitive it becomes to reaction. Small changes in policy expectations create large moves in asset prices. That is why markets feel unstable, rallies feel disconnected, and correlations feel all too shallow. Volatility is actually the enemy. Central banks do not fear low growth. They fear volatility, deltas, rate of change, the volatility of volatility. Because volatility reveals where the bodies are buried. It reveals the leverage. It reveals who's swimming naked. Leverage reveals fragility, insecurity, and fragility forces response. So markets learn quickly, right? They push until volatility rises. They expect stabilization. Price the backstop. This is not conspiracy, this is feedback. Consider two scenarios. Bad data with hawkish policymakers. Markets fall. Liquidity withdraws. Stress compounds. Bad data with constrained policymakers. Markets rise. Liquidity is expected. Risk reprices upwards. Same data, different reaction function. Opposite outcome. Markets ignore obvious problems like debt, demographics, productivity, inequality, not because they don't exist, but because they evolve slowly. Reaction functions evolve incredibly rapidly. Markets trade speed, the volatility, the delta, not truth, not veracity. Globally, capital performs the same calculation. When risk rises, money asks, who will intervene first and hardest, most forcefulliest? Capital flows not to the best economy, but to the most responsive system, the most responsive biome. That is why capital clusters and indices distort. Because the danger is not that markets are wrong. The danger is assuming they are right about reality. They are right about response. This framework holds until intervention loses all credibility. Currency confidence erodes. Solvency replaces liquidity. When reactions no longer stabilize expectations, markets stop front running. They wait and see. That is why when prices becomes incredibly violent. Not before. Never happens before. Stop obsessing over headlines, narratives, forecasts. You need to watch funding stresses, credit spreads, volatility suppression, and policy hesitation. Those tell you where the reaction function is bending. Markets are not lying. They are answering different questions than you are asking. You are asking what is happening. They are asking what will be done about it 6 months down the line. What is the reaction function thereafter? And they trade accordingly. Markets don't price reality. They price the reaction to reality. And until that reaction function actually breaks with alacrity, that is the game. This is the game. Not because it's fair, not because it's just, but because this is how the system is built. Class dismissed. Ciao for now.